Hi, this is Diane Shoemaker with a quick look at the Dairy Margin Protection Program and some changes that recently occurred and some things that dairy farmers need to do before June 1st. Our plan for today is look at the changes, quickly review the basics, what are the changes and the implications for farmers using the Margin Protection Program decision tool, strategies for farms with greater than 5 million pounds of milk, and the sign-up deadline. The Dairy Margin Protection Program was initiated in the Agriculture Act of 2014, or our last Farm Bill. It was not successful in assisting farms manage risk with low milk prices, high feed prices, or a combination of those. And it was particularly unsuccessful in helping with those in the extended low price periods that we have experienced in the past 3 years. To help address those issues, some changes were made in the 2018 Bipartisan Budget Act earlier this year. A quick review, the margin that we are talking about in the Dairy Margin Protection Program is the difference between the all milk price and a feed index. The feed index is a set formula representative of feed costs for lactating, dry, and replacement animals, and it is changed based on current market prices of corn, beans, and hay. Farms are able to protect margins ranging from $4 to $8 per hundredweight in 50-cent increments. Indemnities are paid on the difference between the selected margin coverage level and the announced monthly margin. And there's an example here on your screen that shows what happened in February of this year, where a farm might have protected an $8 margin. The margin was announced at $6.88, so there is an indemnity payment for February of $1.11 and change. In this discussion, we'll be talking about production history, and a farm's production history is set based on the maximum milk sold in calendar year 2011, 12, or 13. The coverage production history premium break that was available in the Margin Protection Program was originally set for the first 4 million pounds of milk produced. It has been raised to the first 5 million pounds, and that encompasses the Tier 1 premium levels. There is a $100 administration fee that provides a minimum $4 margin catastrophic coverage level. New in this round is that a farm can buy up coverage to a $5 margin for that first 5 million pounds with a zero premium cost. A couple other important changes are that indemnity calculations are made and paid each month. In the previous version, margins were calculated each month, but they were averaged over a 2-month period, and any indemnities would have been triggered on that average of 2 months, starting with January, February, March, April, etc. This has two advantages for farmers. If there is a margin indemnity triggered, it is going to be received at the farm level quicker because we're not waiting for the end of that 2-month period for that calculation to be made. And finally, there have been multiple cases where 1 month triggered a payment, the other month did not, but when they were averaged together, no payment was triggered. So it should allow a few more dollars to flow into the dairy community if and when margins are triggered. Premiums were decreased for the first 5 million pounds covered, so the Tier 1 premiums have changed. In the gray column, you'll see the old Tier 1 premiums for less than 4 million pounds of milk. Directly to the right, the new Tier 1 premium schedule. Again, no cost to buy up to a $5 level of coverage, but you'll see significant decreases in cost for margins up to $8. And if we look at that $8 level, the original Tier 1 premium was 47.5 cents per hundredweight. The new Tier 1 premium is 14.2 cents per hundredweight, And the Tier 2 premiums for milk over 5 million pounds have stayed the same, and they are substantially more expensive. And that's most apparent in the $8 level, where buying up coverage to an $8 margin for milk over 5 million pounds would cost $1.36 per hundredweight. Dairies who signed up to participate in the margin protection program in the past had been obligated to participate for the duration of the program. Starting last fall, the Secretary of the Department of Agriculture made the determination that a dairy could opt out in 2018 and not pay the $100 administrative fee. That continues with the rule changes. Fees have been waived for certain groups of farmers for limited resource. Beginning farmer, veterans, and disadvantaged farmers can participate. They would have to pay premiums to buy up coverage, but the $100 administrative fee will be waived. Along with these changes came a reopening in the sign-up period. It opened April 9th, and it will be open through June 1st. Farmers who had made an election in 2017 for the 2018 program must make a new election. So they should go to the Farm Service Agency office, and even if they don't want to change their election, they do need to go back in or they will not be participating. And a really important item is that coverage is retroactive to January 1st. What has not changed is that farms cannot participate both in the Margin Protection Program and Livestock Gross Margin Dairy Insurance Program. Farms who have enrolled in LGM Dairy but not for the entire year do have potential of participating in the Margin Protection Program for the months they have not covered. They will also need to go and work with their Farm Service Agency office. Farms who are considering participation should use the updated Margin Protection Program decision tool, and that can be found at www.dairymarkets.org and is also available through your Farm Service Agency office. The tool will show what the current margins that have been announced are, which we can see with the black line, and it will also update daily the projections through the rest of the calendar year. And you can see the black line estimates where the margins are anticipated to be based on today's information. The green shaded area shows a 25% probability of that margin being higher, and the red band indicates the range of a 25% possibility of that margin being lower. The blue shaded area indicates margins from between $4 and $8. So that is the area in which coverage is available from the Margin Protection Program, with the dark blue line at the $8 coverage level. The tool allows a farm to put their production history in and then look at what the administrative fees and premiums would be, the current expected payments, and expected net returns at the different coverage levels. So coverage levels are available from $4 to $8 in 50-cent increments. So a farm can put their production history in, and then they choose a coverage percent, and that ranges from 25 to 90% in 5% increments. So for this example, this is 1.2+ million pounds of milk, which would be equivalent to about 50 cows at 25,000 pounds of milk sold per year, with an election of 90% coverage, and it will tell you what the covered annual production is. And that will increase a little bit each year for farms that have participated in previous years. Now, in this sample farm, we have put in a 5 million pound annual production history. So this would be probably about 200 cows plus or minus. And at a coverage percent of 90%, the covered annual production is over 4.8 million pounds. Now, at the $8 coverage level, the administrative fees and premiums with our new Tier 1 premiums is $6,927. Currently, the expected payment through the end of the year would be over $19,000 with expected net returns of $12,518. Now, the interesting thing to note is that we already know the January, February, and March margins, and there were payments triggered in both February and March, and it's likely, the way the markets look now, that there will also be a payment triggered in April. So if we would go back and calculate the indemnities for February and March, in most cases they are going to cover those administrative fees and premiums for farms with production history coverage of less than 5 million pounds. So farms could expect that they will get a few dollars, some dollars, from participation in the margin protection program. Challenges come when we're looking at more than 5 million pounds of coverage. So in this case, we've started with a production history of 10 million pounds, assuming this farm has been participating in 2017 and paid their fees in a timely manner. At 90% coverage, we're now covering 9.6 million pounds of milk. So what's happening here is suddenly our administrative fees and premiums are over $69,000 with an expected payment of $38,000. So it actually costs a significant amount of money for a farm to participate, and they will see no net benefit to participation. And this is because a farm can choose one coverage level for all their milk. So if they choose to cover to an $8 level and they're covering 90% of their milk, the first 5 million pounds will be at the lower Tier 1 premium rates, but the remaining 4.6 million pounds of milk will be covered at that $1.38 plus level, which makes these fees and premiums extremely expensive. So this farm does have an opportunity, if they push their coverage level down to a point where their covered annual production is less than 5 million pounds, they're going to be able to take advantage of the $8 coverage level at those administrative fees and premiums, those much lower premium rates. So there is an expected payment and some positive expected net returns, because they can only choose one coverage level for all the milk. So if your production history is above 5 million pounds, you want to get it as close to 5 million pounds covered as possible. If it's greater than 20 million pounds, you'll be buying some Tier 2 protection, because 25 million pounds, even at 25% coverage, is 6.6 plus million pounds. And at that $8 coverage level, there will be some coverage at $1.36 per hundredweight, contrasted to that 14.2%. So based on the calculator's projections on April 25th, and remember that does change every day, the net benefit is a negative number. So each farm really needs to put their numbers through the calculator, because substantial changes have been made to the margin protection program. Every farm needs to look at how it could work for their farm. Sign Up is reopened. It'll be open through June 1st. And even if a coverage decision was made last year for 2018, the farm needs to go back in and do that again. Premiums have to be paid in full by September 1st, and I would really encourage farms that participate get the premiums paid first, and then when those have been covered, use those indemnity checks to help pay a few other bills for this year. So take a look again at the margin protection program. There are some substantial changes that change the opportunities that are available to farms. It is not going to be a magic bullet for any farm. It may bring a few dollars in to help with a few of the bills as we do continue to experience low milk prices and increasing feed prices. This is Diane Shoemaker from the Ohio State University Extension.